Out of all the losses you may have faced in your passive income journey through DeFi, nothing beats the painful yet avoidable experience as impermanent loss. As you may know, putting any of your tokens into a liquidity pool, if you pair them up together, you may actually face some impermanent loss. Now, it's impermanent because your loss doesn't actually get realized until you withdraw the funds from your pool. But if the difference is still there after you withdraw the funds, now the loss becomes permanent. So if you're still confused on what impermanent loss is, I'm going to take a deep dive into it so we can better understand this concept and how you can avoid losing everything you have and get yeeted out of the market. Let's dive in. Now guys, remember, none of this is financial advice and everything I say is purely for educational purposes in this video. So let's continue on. So just a little background. Liquidity pools found on almost every single decentralized exchange have become a popular and lucrative means of earning passive income. It's like a magic well in which you throw coins in and the coins keep coming back into your pocket. So what could go wrong, right? You, as a crypto holder, will pour your liquidity into a liquidity pool by converting your currency into LP tokens. This basically means you're combining two of your cryptocurrencies into a pool. For example, if you are in a USDT BUSD pool in PancakeSwap. The decentralized exchange will take your funds and loan your liquidity out to others and share a portion of the trading fee with you via smart contracts. Unfortunately, among a range of other risks and rewards, you can get stuck with having to face impermanent loss. So what exactly is impermanent loss? When you, as a liquidity provider, face a loss because of a change in the value of assets deposited to a liquidity pool, this is known as impermanent loss. Of course, the more significant the change, the more loss you will have to face. Let's consider an example. Let's say a week ago you went to the pools page on PancakeSwap, and after you consider your options, decide to add liquidity into a TUSD pool. Upon opening the page, you will find that within the said pool, you will have an option of combining a wide range of currencies to create the token. Now, assuming you went with the TUSD BUSD pool, as both are stablecoins, the chances of fluctuation are pretty minimal. Now, there are some risks involved. Let's say, for example, TUSD somehow got exploited or there was a fraud in the company for some reason. Now, this is just a hypothetical. Now, let's say the value of TUSD came out to be 55 cents and not $1. Immediately, your token's value will fall down as well, and based on the number of tokens you had, your loss could be 55 cents or hundreds of dollars. You just faced an impermanent loss. Now, this loss will be realized only when you withdraw the funds. When doing so, you will find that the proportion in which you invested versus the proportion in which you received the assets would be different, and this impermanent loss would become permanent. Now, of course, there is a chance that before you pull out, TUSD clears up the confusion and returns to 99 cents. This isn't that low from its original price, and considering the trading fees you just earned, you may have actually been extremely scared, but ultimately can achieve break even or even profit. Now that we've got the basics covered, let's dive deeper into the world of impermanent loss, automated market maker pricing, and the role of arbitrageurs and how they play into the LP token price shifts. Now, you can think of automated market makers as disconnected price keepers that automatically apply the market formula in any peer contract exchange, determining the final price of an asset. This means basically that whenever a token price changes, the automated market maker doesn't always have to update itself or make adjustments to keep the market in check, or else it would destroy the idea of a decentralized system. AMMs require arbitrageurs to buy or sell the overpriced or underpriced asset until the price offered by the AMM matches the external market. Arbitrageurs do this because they can make the profit, and that profit that they make is deducted from your pocket because you are the liquidity provider. Now, this amount has been deducted on paper because it hasn't actually become a practical loss yet, hence the impermanent loss. In short, arbitrageurs get to profit at the expense of liquidity provider. Now, of course, if you're a bit confused, let's dive into an example. Let's consider the example of Bob, an arbitrager who has an LP token with a 50-50 ratio of two assets, Ethereum and BNB. If there is a change in the price of either one of the two, let's say Ethereum, it would present an opportunity for the arbitrageurs to profit, and you as a liquidity provider to face a loss. Now, the process would be something like the following. You have an equal amount of Ethereum and BNB, so let's assume that they're both equal to $100 in this case. Both sides of your LP token would be balanced. Now, let's assume the price of Ethereum increases by 15%. It would mean that there are less Ethereum than BNB in the pool. Now, this would give arbitrageurs a chance to buy the Ethereum, and that too at 15% cheaper than the original price. Now, they need to sell more BNB to buy the Ethereum, and the incentive therein is a 15% profit margin. Now, this will continue until both sides of the AMM are at equilibrium. Usually, this is done with the help of arbitrage bots, as humans may not be fast enough to recognize, let alone capitalize on this quick price increase. Now, liquidity providers, or you, will continue to get a loss as per the ratio of increase. With a 15% of increase, you will most likely suffer an impermanent loss of $5. If you want to know the exact amount of money you would lose whenever you're providing liquidity to a pool, you can definitely use an impermanent loss calculator. There are many online you can find. And just like that, by leaving your investment in the pool instead of transferring your amount back into your wallet, you just lost $5 and the arbitrageurs won $15 on your investment. So should you not pool your resources in the liquidity pool at all? As mentioned before, when you provide liquidity to a decentralized exchange, you will earn a percentage of the trading fees that the exchange accumulates by using your funds. In many instances, this exchange fee that you earn can actually be a lot higher than what you lose in impermanent loss. Furthermore, when you provide liquidity to a pool, you can earn in-house tokens. For PancakeSwap, for example, this is the cake token, which you can also convert into syrup and so on. If you're also staking in a stablecoin pool with relatively safe stablecoins that are backed by 1-to-1 US dollars in a reserve, then there's not really a huge risk of the value of the stablecoins on either side of the pool depegging, which basically means you can still earn a profit on stablecoins. Much better than a savings account for sure. Now, there is a way if you want to avoid impermanent loss altogether but still enjoy the benefits of yield farming, and that is with staking your single assets. For example, if you take advantage of PancakeSwap staking, now because it's a single asset, you're providing your own single asset rather than two assets combined. This means the price fluctuation will be dependent on just one of the token, in this case, your cake token. And then there will be no impermanent loss, just the price difference that changes with your single asset. Now, when you actually withdraw your cake token, you're going to get the same amount of cake tokens that you put in, and then maybe even some if you put it into an automatically compounding vault. So if you put in 5 cake tokens, you get 5 cake tokens back. However, that doesn't mean the price of the cake tokens will be the same when you do receive your cake tokens back. So keep that in mind. Now, you may be wondering, what is the secret to impermanent loss? Now, that secret is staying vigilant. You will have to take risks to earn more and make the most out of your cryptocurrency. That's what crypto's about, right? The way I see it, you have two options. Go safe and slow with stable coins, or avoid staking altogether. Or your second option is to formulate an extensive strategy with risk mitigation involved, or even increase your risk threshold and stake your assets with impermanent loss in mind. Now, consider your options. Take an in-depth look at your portfolio and decide whether slow and steady is right for you, or fast and aggressive and being the hare is better for you. Now, both options can expand your portfolio, it just depends mostly on your risk tolerance. Now, if you would like to learn more about impermanent loss or have insights or stories to share, get in touch with us on Telegram. Follow our Telegram channel at RugDoc Chat, and then get in touch with us so we can ask and answer any questions you have. Now, guys, stay safe in the DeFi space and have an amazing day.